The air is thick, and Brent oil is whispering a lie that's about to cost people money. Right now, sitting at 106.59, I'm looking at the most perfectly constructed bull trap I have seen in months. The Hormuz Strait transit story should have ripped us toward 110. It didn't. The price is muted, almost sedated. And then, as if the market needed more chaos, Trump drops the line that she wants an Iran deal. One number, one single number, is going to decide whether we collapse back through support or finally break out. That number is 109.38. This is the line where the trap either snaps shut or is blown apart. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use now. Let's declare the session bias. Right now, the bias is a coiled breakout that I expect to fail. I am leaning toward a bull trap above 107.51 that ultimately resolves lower, toward 104.54. The market is trending strong on the daily, but the momentum is secretly decaying. If you want one level that proves my bias dead wrong, it's a clean daily close above 109.38. That's the invalidation. Write this number down. If we break and close above 109.38 on the daily, the whole structure shifts, the trap evaporates, and we are chasing a breakout toward 115. That number is your line in the sand. Engrave it. Now let's walk through the chart, from the top time frames down to the trenches. On the weekly, Brent is in a monster bullish structure. The 20-week moving average is rising sharply, sitting near 103.00, and price has been holding above it like a coiled spring. The 200-week average is far below around 87, completely irrelevant for day-to-day swings, but it paints the long-term bullish backbone. The weekly MACD is expanding above the signal line, no divergence there, meaning the macro path of least resistance is still up. But the weekly doesn't pay you today. The daily chart is where the strong buy trend lives and where the first cracks appear. The daily 20-period moving average is at 105.82, currently acting as a short-term magnetic support. The 60-period moving average is at 103.40. The 200-day sits way down at 97.80 like a distant brick wall. Price has been riding above the 20-day, which screams trend health, but pay attention. The daily MACD histogram has stopped accelerating. The MACD line is still above signal, no negative cross, but the histogram bars are no longer making higher highs. That's the first whisper of fatigue. This is where most traders miss the trap. Now, drop into the 4-hour, and this is where the trap becomes visible. The 4-hour 20-period moving average is at 106.25, price oscillating right around it. The 60-period is at 105.50, the 200-period down at 102.30. The critical technical development is the MACD. Price has been making higher highs above 106.50, but the 4-hour MACD histogram is printing lower highs. Classic bearish divergence. Buyers are exhausted. They are pushing the price up, but with less and less force. When you see a daily strong buy trend paired with a 4-hour bearish divergence, that's the textbook recipe for a fake-out higher, a stop run, and then a sudden reversal. The support floor is clearly defined. The first band is 105.93, which lines up with yesterday's swing low and the 4-hour 60-period average. Below that, the true structural support is 104.54. That's the last bastion before we talk about a trend change. On the resistance side, we have an intraday barrier at 107.51, and the big one, the breakout glass ceiling, is 109.38. That 109.38 level has been tested and rejected before. It's the year's high. It's a brick wall. Now here is the crosser set piece that you must not ignore while we go through the technicals. I'm looking at gold, and gold is screaming risk while Brent oil is whispering apathy. Gold has been ripping, taking out ceiling after ceiling as if a geopolitical crisis is fully priced. If the Hormuz Strait transit tension was genuinely a systemic supply threat, Brent would be surging hand in hand with gold, not dragging its feet below 107.51. This divergence between the fear architect, gold, and the geopolitical heartbeat, oil, tells me that the current oil bid is not a supply panic. It's residual risk on flow from equities. The S&P 500 is still buoyant, and that's keeping a floor under oil. But if equities roll, and that Iran deal narrative gains traction, Brent is exposed to a violent downward correction. Gold is shouting risk, oil is shrugging. That mispricing is an opportunity for those who see it. The dollar index has been flat, not giving a strong directional bias, so the USD is not the driver today. It's purely about the divergence between the two fear assets. Let's connect the last 24 hours core news directly to this price structure. The headline reads, Oil prices muted after transit Hormuz Strait. Think about that. A transit incident in the world's most critical oil choke point, and the market barely flinched. That is a massive signal. It tells you that the market is either heavily long already and unable to rally further without fresh shock, or it's starting to discount geopolitical risk because of a potential diplomatic solution. That solution landed in the form of Trump saying she wants an Iran deal. An Iran nuclear deal that unlocks Iranian barrels. That's a supply injection of potentially 1 million barrels per day. The fundamental weight of that rumor is deeply bearish. If this story gains traction over the next 48 hours, the geopolitical premium built into oil will evaporate. The daily strong buy trend could become a trap that snaps down into the 104.54 support zone faster than most traders can blink. My 1 to 2 week directional lean, therefore, is for a fake breakout attempt above 107.51, a failure, and then a move down to test 104.54. The thesis gets invalidated completely if we get a daily close above 109.38 and momentum confirmation on the MACD, which would mean Iran deal fears are being ignored and a supply disruption is being priced hard. Until then, I'm fading strength. Most people will skip this next section, but this is where money is made. Keep watching. I'm going to give you 3 strategies, each with an exact trigger, a precise stop, and clear targets. The market is giving us a conditional setup. You choose the one that fits your style. Strategy 1, the sniper, conservative. This is for the patient trader who waits for the trap to confirm before pulling the trigger. The idea is to sell into a false breakout that gets rejected sharply at the 109.38 resistance band. The exact trigger. You wait for a spike that pierces above 107.51, ideally tagging 109.30 to 109.50, and then reverses and closes a 1-hour candle back below 109.00 with a bearish engulfing or a long upper wick. That's your entry signal. Once that candle closes, you enter short at market, around 108.90. Your stop loss goes above the spike high, at 109.85. which gives you a buffer above the 109.38 brick wall and around number 110.00. The logic is simple. If the breakout fails and we reject 109.38, the path lower is open. Target 1 is 107.51. That's the previous resistance turn support, locking in a risk-reward of roughly 1 to 2.8. Target 2 is 105.93, the first major demand floor, giving you a risk-reward of around 1 to 5.5. This setup is voided if the price closes above 110.00 on any significant time frame, because that signals a real breakout. Strategy 2. Or the active trader, standard. This one is for the trader who wants to catch the downside momentum early, using a break of a shorter-term structure. The setup leans on the exhaustion I described. We are watching the 60-minute chart, specifically the 200-period moving average, which currently sits at 105.60. I want to see a bearish consolidation break. The entry condition, a 1-hour candle close below 105.55, confirming that the intraday trend has shifted and the bearish divergence is playing out. Enter short on that close at 105.50. Stop loss goes at 106.70. Above yesterday's high and just above the 60-minute 20-period MA, giving a logical structural rejection point. Risk is 1.20. Target 1 is the key support at 104.54, which also aligns with the daily structure. That gives a risk-reward of approximately 1 to 0.8 initially, Not attractive, but that's why we have target 2. Once target 1 is hit, you move your stop to break even and trail it by a 0.60 buffer. Target 2 is 103.00, where the 60-period daily MA sits and where a more significant bid is likely. That stretches the reward significantly. If target 1 is reached, you're in a risk-free trade hunting for target 2. Let's see how aligned we are. Type your Brent range for the next 24 hours in the comments now. I'm reading them, and I'll respond to the most precise calls. Strategy 3, the Aggressor, high risk. This is the countertrend, momentum chase entry for those who believe the trap will fail and the bullish breakout is immediate. Only for those who know how to lose small and manage risk aggressively. The trigger, a clean 30-minute candle close above 107.51 with strong volume and no immediate rejection. Enter long at 107.60. Stop loss sits tightly at 106.70, just below the 60-minute 20-period MA and a short-term support level, keeping risk at 0.90. Target 1 is 109.30, just ahead of the major 109.38 resistance, offering a risk-reward of 1 to 1.9. Target 2 is an extension to 110.80, a level where new highs often face selling pressure, giving a risk-reward of 1 to 3.5. If price hesitates at 109.38 and prints a rejection candle, exit immediately. This trade is invalidated if the breakout candle closes back below 107.51 within the next hour, turning it into a failed breakout. Never risk more than 1 to 2% per trade. No positions through high-impact news events. Stops are non-negotiable. The single most critical level for the next session is 107.51. If Brent fails to reclaim it and breaks the 60-minute 200-period average, the trapdoor opens toward 104.54. If it holds and we grind higher, the battle at 109.38 becomes the whole game. Tomorrow, I'll be dissecting the API inventory data and any further Iran deal headlines, because a surge in crude inventories combined with a deal narrative would be the knockout punch for the bulls. If you want the full breakdown on gold and the S&P divergence, that video is live now. Check the end screen. Gold is screaming a message that oil traders are ignoring, and it could be the trade of the week. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage. I'll see you in the next one.